Feels like Wall Street's playing a game we're not invited to, huh?
Oh, tell me about it.
Today, February 25th, 2025 was a doozy.
Yeah, definitely a lot to unpack.
We've got analyst reports coming out left and right trying to make sense of it all.
And that's why we're here.
To try and make sense of it all.
That's right.
So the Dow Jones decided to have a party. It seems closing up 0.4%.
Yeah, good day for the Dow.
But the tech-heavy Nasdaq, well,
not so much.
Yeah, down 1.4%.
Quite a contrast.
It really is.
Like they're in two different worlds.
Yeah, totally.
Yeah.
So let's dig into that tech slump a little bit.
Okay, sounds good.
Why is the Nasdaq feeling the pain?
Mm-hmm.
We're seeing big names like Nvidia down 3.2% and Tesla down 2.8%.
Well, I think there's a lot of anxiety about the future of AI. You know, is this rapid adoption we've seen slowing down? Are these valuations getting out of hand?
So those are the questions on everyone's mind.
Yeah, the whispers on Wall Street.
And it's causing some jitters.
Definitely some jitters.
So Nvidia's earnings report is coming up soon.
Right.
Is this drop kind of a bad omen?
It's something to watch, that's for sure. You know, Nvidia, they're often seen as a barometer for the entire tech sector.
Right.
If they don't deliver, it could send shockwaves through the market.
It could.
And Tesla, they're still battling those production and delivery issues.
Yeah, those haven't quite gone away.
Not yet.
All right, so tech is in a bit of a funk, but the Dow's dancing.
Yeah, good old reliable Dow.
Our good friend Home Depot to thank for that.
You got it. They actually beat earnings expectations.
Did they really?
Yeah, 3.45 per share compared to the projected 3.38.
Wow.
Someone's smiling.
Yeah, someone's happy.
But you know what they say?
All that glitters.
Isn't gold?
Right.
There's a bit of a shadow lurking behind that positive report.
What do you mean?
They also issued a pretty weak outlook for the year.
Oh.
Blaming the usual suspects, of course.
Inflation, supply chain issues.
Yeah, the hits keep coming.
It never ends.
It's the story of our lives right now.
Okay, so this is where it gets interesting.
Okay.
Most U.S. stocks actually finished higher, right?
Yep, that's right.
But the Nasdaq had more decliners than winners.
More losers than winners, yeah.
What does that tell us?
Well, it tells us that investors are being really cautious. It's like they're walking on eggshells. Yeah, there's a real sense of unease, a hesitation to jump in with both feet.
Makes sense.
We even saw below average trading volume today.
Oh, really?
Yeah, another sign that people are holding back, waiting to see what happens next. Waiting to see which way the wind's gonna blow.
So it's all about the vibe.
I think so.
The mood.
The mood on Wall Street.
Yeah, and what are the experts saying about this cautious dance everyone's doing?
Well, one analyst put it really well, I thought. They said, the market is reflecting broader concerns about economic growth.
Makes sense.
And another pointed out that investors are looking for safety. They said they're seeking safer havens, like bonds. So like battening down the hatches.
Yeah, exactly.
Bracing for impact.
Right. Unsure if this is just a little bump in the road or the start of something bigger.
So we've got nervous investors, mixed signals, and tech taking a hit.
It's a recipe for uncertainty, that's for sure.
What kind of ripples does that create in the bigger picture?
Well, for starters, Treasury yields actually fell today.
Did they?
Yeah, dipped to a 12-month low.
Wow, so what does that mean?
Well, it's significant because it tells us that investors are moving their money into assets that are seen as more stable.
Okay.
Like bonds.
When uncertainty looms.
Exactly. When the going gets tough, people go for the safe bets.
Hold on, back up a little bit.
Sure.
Why are bonds considered a safe haven?
Well, think of bonds as the steady eddy of the investment world.
Yeah.
They tend to be less volatile than stocks, especially government bonds. So when you're worried about the economy, bonds can feel like a pretty comfy place to park your money.
So that's what this yield drop means. Yeah. More people are buying them, driving up demand, pushing the price up.
Because they're scared.
Basically, yeah.
And how does all this Wall Street drama impact the everyday lives of, people like our listener?
Well, that's the thing. All this uncertainty, it trickles down.
It does.
Consumer confidence actually took a hit, dropped to 108.5 from 110.5 in January.
Oh, wow.
Yeah, and that's directly tied to all the anxieties we've been talking about.
Inflation, the economy, the whole 9 yards.
Yeah, when people feel less confident about the future, they tend to spend less.
Right.
Which can then slow down the economy even more, create more market volatility.
Vicious cycle.
It really is.
So what are the big things on the horizon that can push the market one way or the other? What should we be watching?
Well, there are a few key events coming up that could be game changers.
Okay, like what?
First, we've got the Federal Reserve meetings where they'll be deciding on interest rates.
Right.
Their moves could have a major ripple effect.
Yeah, interest rates affect everything.
Absolutely.
Borrowing costs for businesses, mortgage rates for home buyers.
It's a big deal.
It's a big deal.
And speaking of potential turning points, we can't forget about NVIDIA's upcoming earnings report.
Right.
That one's going to be huge.
Yeah, all eyes on that.
It could either confirm those fears of a tech slowdown or give investors a much-needed sigh of relief.
So, two major things to watch.
Two big ones.
Anything else?
Yes. The PCE inflation report.
What's that?
It's the Personal Consumption Expenditures Price Index.
Oh, okay.
It's the Fed's favorite way to measure inflation.
So it's a pretty big deal.
It is, yeah.
So it's going to give us a much clearer picture of,
right.
How healthy the economy actually is.
Exactly.
So if inflation is still running hot, the Fed might have to raise interest rates even more.
That's the worry.
Yeah.
And higher interest rates usually mean higher borrowing costs, which can slow down economic growth.
Right.
Potentially lead to lower corporate profits, lower stock prices.
It's a delicate balancing act.
Yeah, it really is.
It sounds like we're at a crossroads.
I think that's a good way to put it.
The decisions made in the next few weeks could really determine where the market goes from here.
No doubt about it.
So it's crucial to stay informed.
Absolutely.
Trying to understand what's happening.
The forces at play.
Right. So we've laid out the big picture.
Yeah, we've covered a lot of ground.
Let's zero in on some of the specific companies.
Okay.
Making headlines today.
Sounds good.
We talked about Home Depot's mixed bag of news, but what are they actually worried about?
Well, they're facing the same headwinds as a lot of companies right now. Inflation, supply chain disruptions.
Right, those again.
Yeah, inflation is eating into their profit margins.
Makes things more expensive to produce and sell.
That's right.
And supply chain issues make it harder to get the materials they need.
And more costly.
Leading to potential delays.
And higher prices, yep.
So even a giant like Home Depot isn't immune.
Nobody's immune to these economic challenges.
What about NVIDIA and Tesla?
Yeah, the tech titans.
They're both facing their own battles, right?
They are. NVIDIA's grappling with those concerns about a potential slowdown in AI adoption.
Right.
They're a major player in the AI chip market.
Right.
So if that sector weakens...
It could hit their bottom line pretty hard.
It could, and their upcoming earnings report, well, that's going to be a nail-biter.
The whole tech world's holding its breath.
Exactly.
And then there's Tesla.
Yeah.
Still struggling to meet their production and delivery targets.
Right. They've had some high-profile hiccups.
Yeah, I've heard about those.
Led to customer frustration, questions about their ability to scale up effectively.
It seems like every company out there has its own
set of hurdles to overcome.
Yeah.
It's a tough environment out there.
It is. It is.
But that's what makes the market so dynamic.
And unpredictable.
Exactly. You never know what's going to happen next.
Speaking of unpredictable, let's circle back to those contradicting signals we saw today.
Okay, yeah.
How can the majority of U.S. stocks be moving up while the Nasdaq, which is heavily weighted towards tech, is down?
It's a great question, and I think it highlights the fact that the market is rarely black and white.
Right.
While tech might be struggling.
Other sectors could be doing well.
Right. Offsetting those losses, pushing the broader market higher.
So it's all about looking at the bigger picture.
Absolutely.
Understanding all the different forces at play.
Exactly. It's a complex puzzle.
It's not just about following the headlines.
Nope.
It's about digging deeper.
Digging deeper, analyzing the nuances.
That's why we need experts like you.
Oh, shucks.
To guide us through this maze.
Happy to help shed some light on things.
So where do we go from here? What are your final thoughts for our listener?
Okay, so my advice would be to stay informed, but don't let the headlines dictate your emotions.
Okay.
Develop a clear investment plan that aligns with your goals and risk tolerance.
Right. Have a plan.
Don't let short-term market fluctuations derail your long-term strategy.
Long-term thinking.
Exactly. Investing is a marathon, not a sprint.
Solid advice. It's easy to get caught up in the frenzy.
It is. It is.
But staying focused on your goals is key.
Absolutely. Anything else I'd add? Yeah, remember that the stock market is a reflection of the economy, and economies go through cycles.
Right.
There will be ups and downs along the way, but over the long term, the market tends to trend upwards.
So stay the course.
Stay the course.
Don't let fear drive your decisions.
Don't let fear make the decisions for you.
Great advice.
I try my best.
Thank you for sharing your insights with us today.
It was my pleasure.
And to our listener, we hope you're finding this analysis helpful.
Hope so.
Remember, knowledge is power.
Yeah, Knowledge is power.
Understanding the market
Right.
can empower you to make more informed decisions about your investments.
Exactly.
Until next time,
See you there.
happy investing.
Happy investing. You know, we talk about investor caution, but what's really driving that? What are those factors?
Yeah, let's get inside their heads a little bit.
What's making them hesitate? Well, I think fear is a big one.
Makes sense.
Fear is powerful, especially when it comes to money.
Oh, yeah.
You know, when people are afraid of losing their savings, they don't always think straight.
Fear can really cloud your judgment.
It absolutely can.
So how can investors avoid getting swept up in that fear?
Well, having a clear investment plan and sticking to it is crucial. Don't let those daily ups and downs derail your long-term goals.
So it's like a roadmap.
Exactly. It helps you stay on track when things get bumpy.
Don't lose sight of the destination.
Right. And another key is to focus on the fundamentals.
Okay.
Remember why you invested in a particular company in the first place. Does the underlying story still hold true?
Don't get distracted by the noise.
Right. And always remember, the market is cyclical.
Ups and downs.
There will be periods of growth and periods of decline, but over the long term, the market tends to go up.
So stay the course, even when it gets rocky.
Stay the course.
Okay, we've talked about fear, but what about greed? Does that play a role too?
Greed can be just as dangerous as fear, to be honest.
Oh, how so?
Well, when investors get greedy, they often chase returns, taking on more risk than they normally would. And that can lead to some pretty bad decisions.
Bulls make money, bears make money, pigs get slaughtered.
Exactly. It's all about finding that balance between fear and greed.
Being cautious, but not paralyzed.
Right, and being opportunistic, but not reckless.
So how do you find that sweet spot, that balance?
Well, diversification is a good starting point.
Diversification, the classic advice.
It's a classic for a reason.
Don't put all your eggs in one basket.
Exactly. Spread your investments across different asset classes, industries, geographic regions.
Right, to cushion the blow if one area takes a hit.
Exactly. But isn't it true that diversification becomes less effective during a downturn?
That's what I've heard.
Yeah, because everything tends to fall together.
Right.
That's true. Correlation across asset classes tends to increase during times of market stress.
Okay.
But even in a downturn, a well-diversified portfolio will likely perform better than a concentrated one.
So it's not about eliminating risk, but managing it.
That's right. It's about managing risk effectively.
Okay, so diversification is still a valuable strategy.
It definitely is.
Even if it's not foolproof.
Right.
Yaros.
Having realistic expectations is crucial.
Don't expect to get rich quick.
Exactly. Investing is a long-term game.
Slow and steady wins the race.
That's it. Slow and steady. And there's no shame in taking profits.
Oh, you mean like...
If you've made a good return on an investment, it's okay to sell.
Lock in those gains.
Don't let greed keep you holding on for that last little bit of upside.
Don't be afraid to walk away from the table when you're ahead.
Exactly. Knowing when to take profits is just as important as knowing when to buy.
Okay, so we've talked about fear and greed, but are there any other psychological traps investors should watch out for?
Oh, plenty. One is overconfidence. When investors are overconfident, they tend to overestimate their ability to pick winners.
Oh, yeah, like thinking you're a better driver than everyone else.
Exactly, and that can lead to some bad decisions.
Right.
Another common trap is herd mentality.
Herd mentality, what's that?
It's the tendency to follow the crowd.
Even if it means making irrational decisions.
Exactly, like buying a stock just because everyone else...
You're without doing your own research.
That's right, you got to do your homework. And then there's anchoring bias.
Anchoring bias.
This is when investors get fixated on a particular piece of information.
Even if it's not relevant anymore.
Exactly, even if it's outdated.
So how do you avoid falling into these traps?
Well, awareness is key. Once you're aware of your own biases, you can start to make more rational decisions.
It's like shining a light on your blind spots.
Exactly. Self-awareness is a powerful tool.
So the takeaway here is that psychology plays a big role.
A huge role.
In how the market behaves.
Without a doubt.
And understanding these factors can help investors make better decisions.
And avoid those costly mistakes.
Great advice. Thanks for helping us break down all this.
It's my pleasure. I always enjoy talking about behavioral finance.
It's fascinating stuff.
It really is.
And to our listener, we hope you're finding this analysis insightful.
I hope so.
Remember, knowledge is power.
Knowledge is power.
And understanding what drives the market.
Both the rational and the psychological.
Right, can help you make smarter decisions.
Exactly.
All right, so we've covered a lot of ground today.
Have.
But there's one more thing I want to touch on before we wrap up.
Okay.
Investor psychology.
Right.
We talked about the mood on Wall Street being cautious, but what are some of the specific psychological factors at play?
Well, I think fear is definitely a big one.
Fear, again.
Yeah, when people are afraid of losing money, they tend to make more emotional decisions.
Yeah.
And that can lead to some irrational market behavior.
Fear can be a powerful motivator.
Oh, absolutely.
For sure.
It can also be contagious.
Contagious.
Yeah, when one investor starts to panic, it can trigger a chain reaction.
Oh, wow.
Leading to a widespread sell-off.
So how can investors avoid getting caught up in that fear frenzy?
Well, one way is to have a clear investment plan.
You're right, a plan.
And stick to it.
Don't let the market's mood swings derail you.
Exactly. Don't let short-term market fluctuations derail your long-term goals.
It's like having a roadmap. Keeps you on track.
A roadmap for your investments, that's a good analogy, even when the terrain gets rough.
Right. Another way to combat fear is to focus on the fundamentals.
Okay, back to basics.
Remember why you invested in that company in the first place. Don't lose sight of the big picture.
Right, the fundamentals.
Exactly. And finally, remember that the market is cyclical.
Ups and downs. There will be ups and downs, but over the long term, the market tends to trend upwards.
So stay the course.
Stay the course. That's the key.
Okay, so we've talked about fear, but what about greed? Does that play a role in investor psychology too?
Absolutely. Greed can be just as dangerous as fear.
Oh, wow.
When investors get greedy, they tend to chase returns.
Chasing returns.
Yeah, they take on more risk than they would normally. And that can lead to some risky investments they wouldn't normally consider.
Bulls make money, bears make money, pigs get slaughtered.
That's a good one. It's about finding that balance
Well,
between fear and greed.
Right, being cautious but not letting fear paralyze you.
Right, and being opportunistic but not letting greed lead you astray.
So how can investors find that sweet spot?
Well, one way is to have a diversified portfolio.
Diversification, again.
It's important. Don't put all your eggs in one basket.
Spread the risk.
Exactly. Spread your investments across different asset classes that can help mitigate risk.
And reduce the temptation to chase returns.
Exactly. Diversification is key.
I hear that all the time.
It's true. It's one of the most fundamental principles of investing.
Okay, so diversification is important. What else?
Having realistic expectations is also crucial.
Don't expect to get rich quick.
Right. Investing is a long-term game. It's a marathon, not a sprint.
Slow and steady wins the race.
Exactly. Slow and steady. And finally, remember that there's no shame in taking profits.
Taking profits.
If you've made a good return on an investment, it's okay to sell and lock in those gains.
Don't be afraid to walk away from the table when you're ahead.
Exactly. Knowing when to take profits is just as important as knowing when to buy.
Okay, so we've covered fear and greed. Are there any other psychological factors investors should be aware of?
Yes, there are a few others. One is overconfidence.
Overconfidence.
When investors are overconfident, they tend to overestimate their ability to pick winning investments.
Right, like thinking you're a better driver than everyone else.
Exactly. It can lead to some poor decisions.
Because you think you know more than you do.
Exactly. Another factor is herd mentality.
Herd mentality, what's that?
This is the tendency for investors to follow the crowd, even if it means making irrational decisions.
Like buying a stock just because everyone else is.
Exactly, without doing their own research. And finally, there's anchoring bias.
Anchoring bias.
This is the tendency for investors to fixate on a particular piece of information, even if it's irrelevant or outdated.
Like holding onto a stock because it used to be a good performer.
Exactly, even though the fundamentals may have changed.
So how can investors avoid these psychological pitfalls?
Well, the best way is to be aware of them.
Okay.
Once you know what your biases are, you can start to make more rational decisions.
It's like shining a light on your blind spots.
Exactly. Self-awareness is crucial when it comes to investing.
So what's the takeaway for our listener?
The takeaway is that investor psychology plays a huge role in market behavior.
It does.
By understanding these psychological factors, investors can make more informed decisions and avoid costly mistakes.
Great advice. Thank you for sharing your insights with us today.
It was my pleasure.
All right, so we've talked about the big picture, the Dow's strength, tech struggles, the overall mood on Wall Street, but let's bring it all home for our listener. You're out there, following the market, trying to make sense of it all. What are some takeaways, something practical you can use?
I think a big one is context is king. Like Home Depot's earnings beat might sound great on the surface, but then you consider their weaker outlook, it paints a different picture.
Yeah, it's not the whole story.
Exactly. Don't just look at isolated data points. You got to understand the forces behind them.
So it's like a detective novel.
Precisely. You got to piece together all the clues to see the full story.
Find the real culprit.
And another takeaway, even in a volatile market, there are opportunities.
Oh, interesting.
The fact that most U.S. stocks advanced, it shows that not everything is sinking. This could be a time for savvy investors to find those undervalued companies or sectors that are poised for growth.
So it's about finding those diamonds in the rough.
Exactly. But it requires research, you know, and a willingness to look beyond the headlines.
Don't just follow the herd.
Right. Remember those analyst quotes we talked about? Seeking safer havens? That tells us that bonds are attracting attention right now. That might be a signal for some investors, but it's not a one-size-fits-all solution.
It all comes back to understanding your own risk tolerance, investment goals, and doing your homework.
Couldn't have said it better myself.
All right, so before we wrap up, any final thoughts? Something to leave our listener with?
Let me see. Here's a thought-provoking question. We've talked about all these economic fears driving investor caution, but could there be something deeper at play?
Oh, intrigue me.
Are there underlying societal shifts, maybe even technological advancements that are subtly influencing the market in ways we haven't fully grasped yet?
Now, that's something to think about. It's a reminder that the market isn't just about numbers.
Right.
It's a reflection of human behavior, innovation, the constant evolution of our world.
Exactly. So keep your eyes open, stay curious, and always be willing to challenge your assumptions. The market, like life, is full of surprises.
Well said. That's a perfect note to end on. Thanks for joining us on this wild ride through the market today.
My pleasure.
We hope you're walking away with a better understanding of what went down, why it matters, and most importantly, how it might impact your own financial journey. Until next time, happy investing.